Charlie Munger's 30-year rule is blunt. If you can't imagine owning something for 30 years, don't buy it. People race for quick wins and trade too often. That habit eats returns and wastes time. Think about two choices: flipping a neighborhood coffee shop every year or buying a small piece of a dominant brand and never touching it. One choice demands daily babysitting, renovations, and stress. The other quietly compounds, pays dividends, and keeps growing while you sleep. Long-term ownership does more than increase money. When you stop reacting to every market headline and stop paying for turnover, you free yourself to choose how you spend your time. Less noise, more control. Later in this video, you'll see a practical way to apply the 30-year lens. 3 simple questions that turn vague intuition into clear decisions, plus real-life examples of where the rule works and where it fails. That's the point. Change the way you buy, and you change the life you build. How Munger's 30-year rule came about. A lot of people feel trapped by the need to react to every market twitch, and that pressure is exactly what pushed Munger toward a simple thought experiment about ownership. He trained his mind to prefer durable answers, not quick fixes, because his background demanded precision and patience. Working as a lawyer taught him how to read complicated contracts and distill enduring obligations from messy details, and that habit of looking for permanence carried straight into how he evaluated businesses. The result was a preference for investments you could hold without agonizing over daily headlines. Watching business owners work up close created another kind of lesson for him. He saw companies run by people who thought in decades instead of quarters, and those companies built advantages that survived short-term shocks. That observation led him to favor assets that reward long-time horizons. Owning a company that keeps gaining a little bit each year compounds into something meaningful. Concrete examples at Berkshire, like holding recognizable, cash-generating brands rather than flipping trendy tech bets, illustrate how long holding periods translate into simpler, more reliable outcomes. Practical friction made the rule attractive too. Transactions cost money and attention, and taxes bite at gains when you trade often. When Munger compared the mental and financial drag of constant trading to the peace that comes from owning great businesses outright, the choice became obvious. By thinking in decades, he and his partners reduced wasted effort, cut down on needless fees, and freed themselves to focus on big-picture decisions instead of minute-by-minute noise. His intellectual toolkit shaped the neat form that rule took. Munger learned to borrow ideas across fields, economics, psychology, law, and that cross-pollination produced heuristics that stick. A 30-year lens is less about an exact count and more about forcing the question: would this still make sense if first never had to sell? Putting it that blunt way turned a complex investment decision into a clearer test, one honed by experience, by watching long-lived businesses succeed, and by the practical benefits of less churn. Thinking like a long-term owner, logic behind the time frame. Many people trade stocks and change jobs in a hurry. The 30-year lens flips that instinct. It forces you to treat a share or a business as something you might live with through many business cycles, not a ticket to quick gains. Because time lets compound effects unfold, the same steady profit margin becomes vastly more valuable when it keeps growing without interruption. Think of a company that raises prices a little and reinvests slowly in distribution. Over decades, that small engine of growth turns into a wide moat. There's a tension between short-term reporting and long-term value creation. When an owner plans to stay for decades, they behave differently. They preserve reputation, invest in employees, and accept slow returns now because those choices lower risks and expand opportunities later. A CEO chasing quarterly beats might slash R&D and cut staff to boost earnings this quarter, which lifts the stock briefly but erodes the business's future. By contrast, a long-term owner tolerates volatility and funds projects that compound, like steady brand building or product development, because the payoff accumulates over many years. Thinking in 30-year blocks changes how you judge value. You don't get distracted by daily price moves when your goal is predictable cash flows and durability. That reduces turnover, which in turn cuts transaction costs, realized tax events, and the psychological drain of constant decision-making. Consider a landlord who keeps a rental property. Skipping frequent flips means fewer renovations, less vacancy churn, and steadily rising net income from tenants who stay. The same principle applies to equities. Lower churn preserves gains and harnesses compounding. The time frame also sharpens your choice of what to own. You start preferring businesses with simple economics, strong brands, or entrenched distribution, because those traits survive lots of change. You ask different questions. Will managers first entrusting this to still be making sensible calls in 10, 20, 30 years? That leads to buying companies where leadership cares about the business beyond next quarter's headline, or acquiring entire businesses and leaving capable operators in place. Over time, that steadier stewardship builds real freedom, less time spent firefighting, more ability to pursue improvements that matter. Ownership, freedom, and the trade-offs over decades. Owning a controlling piece of a business usually means more control over choices, and that control brings both freedom and responsibility. When you call the shots on hiring, pricing, and reinvestment, you can ignore quarterly noise and focus on building long-term value, which changes the kinds of decisions you make every day. That feels liberating. But because the capital and outcomes tie back to you personally, the freedom comes with obligations like payroll, regulatory compliance, and the need to defend market position. It keeps you involved in the slow grind as much as it frees you from outside pressure. Holding an asset for decades cuts down on friction. Fewer trades mean fewer brokerage fees and less tax drag from short-term gains, so a larger share of the business's return stays compounding under your ownership. This difference shows up concretely. An investor who sells and buys repeatedly faces more paperwork, more transaction costs, and often worse net returns than someone who buys a handful of durable businesses and lets retained earnings do the work. It simplifies life too. Fewer meetings about repositioning portfolios and more focus on the business itself. Those benefits come with clear trade-offs. Locking large sums into a company or a concentrated stock position reduces liquidity, which can prevent you from taking advantage of new opportunities or force you to sell into a weak market if cash is needed. Concentration magnifies idiosyncratic risk. A failed product, a lawsuit, or a management error can trim or wipe out wealth in ways a diversified basket might not. Owners also absorb non-financial burdens, employee livelihoods, landlord relationships, and reputational exposure, and those obligations can limit personal freedom even while the balance sheet looks strong. People handle these tensions differently as decades pass. Some keep a core holding they rarely touch while placing a portion of capital into diversified index funds for liquidity and optionality. Others hire professional managers and build governance rules so the founders retain strategic control without running daily operations. A family that owns a regional chain of clinics, for example, might appoint an external CEO and keep a cash reserve and passive investments on the side, which lets them avoid selling core assets in a downturn and still benefit from compounding. That layered approach reduces the likelihood of forced sales and smooths the trade-off between control and flexibility. Ownership over long horizons also reshapes personal life plans and succession choices. When you plan to own something for decades, you tend to prioritize legacy, culture, and durable customer relationships instead of short-term margins, and that can strengthen employer loyalty and community standing. But it also means thinking early about who will run things when you step back, and succession itself becomes a multi-year negotiation requiring legal, tax, and human capital work. Practical freedom, then, isn't just a function of capital. It's a product of structures you build and trade-offs you accept along the way. Real-life scenarios. Applying the rule to jobs, investments, and relationships. Employees who stay long enough to learn the hidden levers inside a company usually earn real negotiating power, and that changes what ownership feels like. A software engineer who joined a small startup, stayed through product pivots, and then moved into a senior role often ends up with both a meaningful equity stake and the institutional knowledge to protect it. That combination lets them shape decisions instead of reacting to them. Jumping every year for slightly higher pay hands away that leverage because new employers rarely give big ownership to rank-and-file hires without proven long-term contribution. So think in terms of cumulative influence. Time invested builds reputation, and reputation converts into options, board seats, or the chance to spin a team into a new company. Many investors forget that compounding rewards patience, and short-term tinkering eats returns through fees, taxes, and missed growth. Buying a diversified index fund and holding it through market cycles looks boring on a daily basis, but it avoids the drag of frequent trading and the risk of selling in a panic. Real estate illustrates the same point. A rental bought in a neighborhood where demand grows slowly tends to pay down principal and raise rent over time, creating equity and income that you can only realize by holding. The effect is simple. Fewer transactions mean lower costs and more of the upside stays with you. People treat relationships as experiments sometimes, and that creates friction and wasted effort in both personal and business arenas. Co-founders who split equity upfront without vesting or clear role boundaries can dissolve partnerships quickly because there's no structure that rewards staying and contributing. Couples who plan finances together, set shared goals, and agree on checkpoints build a form of social capital that makes long-term projects, buying a home, starting a business, raising kids, feasible. Trust compounds like money. It reduces monitoring, speeds decisions, and lowers the chance of disruptive breakups. But it needs boundaries, so staying is a choice, not an obligation. The obvious tension is that life changes and a 30-year horizon sounds inflexible when careers, markets, or feelings shift. You can preserve long-term orientation without being trapped by using staging mechanisms. Equity vesting for founders and key hires, phased ownership transfers in family businesses, or financial agreements in relationships that protect both parties while allowing reassessment. For example, many startups use time-based vesting so a founder earns ownership only as value is created, that aligns incentives without forcing a permanent tie if the fit is wrong. Those structures create cause and effect. Commitment earns ownership, and ownership rewards contribution, while keeping exit routes realistic. Most people juggle jobs, investments, and relationships at once, and that interaction determines real freedom. Maintaining an emergency cash buffer prevents you from selling investments at the worst time and gives you the option to leave a toxic job or relationship without immediate ruin. Keeping a small, tradable portion of your portfolio also preserves mobility, even as you hold core assets for the long haul. Networks matter too. A strong professional reputation and a trusted inner circle function like equity in social form, giving leverage to change roles or start ventures without starting from zero. When each domain is treated with a long-term lens but practical safeguards, ownership becomes both a source of wealth and a platform for freedom. Practical framework. Questions to ask before committing for 30 years. Public markets often push companies towards short-term results, and that pressure changes what ownership looks like over decades. Ask whether the business's revenue comes from habits or one-off purchases. A company that sells a daily consumable or a subscription has a fundamentally different durability than one selling fads. Look for examples you can relate to. A grocery staple that people buy every week behaves differently from a standalone gadget that depends on a hot trend. If demand is habit-driven, the chance of holding comfortably for many years goes up. Regulatory and technological risk matter more than buzz. Consider whether the product or service will be legal, useful, and competitive under reasonable technological shifts. A business tied to tightly regulated infrastructure usually has predictable returns. A platform built on a single proprietary technology can be disrupted. Ask whether there are clear switching costs for customers, and how easy it would be for a well-funded rival to copy the offering. If switching costs are high, your downside is smaller. Management decisions compound over long holds. Think about incentives, ownership, and capital allocation history. If leaders consistently plow cash back into the business or buy attractive assets, compounding can work in your favor. If they regularly dilute shareholders or prioritize short-term earnings to meet targets, that behavior will erode value over time. Look for concrete signals, insiders buying stock, transparent explanations of strategy, and a record of shareholder-friendly moves. A company's financial plumbing determines whether it can survive bumps. Check whether earnings are backed by recurring cash flow, how cyclical revenue is, and whether debt levels are manageable under stress. A business with steady free cash flow can fund reinvestment and weather downturns. One dependent on optimistic growth projections cannot. Think in scenarios. What happens if sales fall 30% or margins shrink by half? Can the firm still meet obligations? Your personal situation matters as much as the business's prospects. Ask whether holding for 30 years fits your liquidity needs, tax situation, and emotional tolerance for volatility. Concentrated ownership demands confidence and the ability to ignore headlines. If you need predictable withdrawals or have near-term goals, a permanent stake may be a poor match. Match the company's characteristics to your life. Steady cash cows suit income needs. High-growth firms suit those who don't plan to touch the money for a long time. Ever feel like you're on a hamster wheel, always trading or chasing the next shiny return? Charlie Munger's 30-year rule boils down to a few plain ideas. Buy ownership you can hold for decades, prefer businesses or stakes with durable advantages, and structure them so they generate cash without you babysitting every day. Hold long enough and compounding works its quiet math. The result is fewer decisions, lower taxes on short-term flips, and more freedom to actually live. It can sound risky to lock in for 30 years. But think about a small laundromat that pays steady profit every month versus trying to day trade your way to security. One gives predictable cash and the other steals your hours. When ownership produces reliable income, you don't need to be in the office at noon or worry about a paycheck every Friday. That predictability is what lets people scale back work, take creative risks, or spend more time with family. You're probably juggling bills, a career, and plans for the future. If you set your sights on owner-like assets, a stake in a well-run private business, a quiet rental that covers expenses, or shares in a company you'd happily keep, your choices change. Instead of non-stop switching, you prioritize durability and cash flow. That's how a side business that once paid $500 a month can turn into real optionality over time. This approach isn't a magic trick, and it won't suit every day or every market. But if this landed for you, stick around. There will be real case studies ahead showing how people found owner-like income and what the early steps looked like. If you'd like more of those stories and practical examples, you might follow the channel and join the discussion below. Think of Munger's 30-year rule as a compass, not a map. It points toward freedom, and the next videos will help you walk the path.